You're in the supermarket looking at a carton of eggs. $7. $7. You remember when they cost 2, maybe 3 on a bad day. You glance around. Bread, milk, coffee, everything is more expensive. And you're thinking, didn't they say inflation was under control? So why does it feel like your paycheck buys less every single month? Stay with me, because what I'm about to walk you through is exactly the kind of thing the government would rather you didn't think too hard about. They tell you inflation is down to 2.8%. Mission accomplished. The economy is recovering. But here's what they don't spell out. That 2.8% is a year-over-year figure. It's a comparison to last year that hides the real story, the total cumulative damage from 2020 until now. Think of it this way. If I punch you in the face 10 times today and only twice tomorrow, technically the punch rate went down, but your face still hurts. It's still swollen. That's what has happened to your purchasing power. The rate slowed, but the damage stayed. Let me walk you through the actual math they hope you never sit down and calculate. Let's look at what really happened to your money. Imagine in 2020 you had $1,000 of purchasing power. Then, 2021, inflation around 7%, 2022, about 9.1%, the highest in 4 decades, 2023, roughly 4.1%, 2024, about 3.4%, 2026, around 2.8%. See, they say, it's slowing. Everything is fine again. But inflation doesn't run in reverse. Those percentages stack on top of each other. They compound. So that $1,000 in 2020, by 2026, in real terms, it only buys about $760 worth of goods and services. In 6 years, you've lost close to a quarter of your buying power. And you might be thinking, well, didn't my salary go up too? Did it rise by about 28%? Because if your income didn't keep pace with that cumulative inflation, you fell behind. Most people have seen wages rise maybe 10 to 15% at best. The numbers are simple. Even if you got a raise, you are still poorer in real terms than you were 6 years ago. Here are some real-world comparisons from 2020 to now. Average rent, about $1,104 per month then, around $1,748 now. Dozen eggs, about $1.51, now roughly $4.25 on a good day. Gallon of gas, around $2.89, now closer to $3.89. Ground beef per pound, about $3.89, now roughly $6.57. These are not abstract theories. This is what you're living every time you go to the store or pay your bills. So if inflation is supposedly under control, why does everything still feel unaffordable? There are 3 big reasons you're rarely told about. Reason 1, corporate profit dressed up as economics. During the pandemic, companies hiked prices and blamed supply chain issues. In the short term, that explanation made sense, but many of those supply chains stabilized by late 2023. Did prices fall back? No. Once people got used to higher prices, a lot of big corporations simply kept them there and continued to point to inflation as the excuse. Profit margins from major food and consumer companies have hit record levels, with some seeing 50 to 70% jumps in net profits. They're not innocent victims of inflation. In many cases, they're profiting from it. Reason 2, the housing squeeze. Rents keep climbing partly because of institutional investors. Large firms, including names like BlackRock, bought up homes during and after the pandemic, shifting housing from something you own into something you rent on their terms. When Wall Street turns residential property into an investment product, you stop being a tenant in the traditional sense and become a line item in someone's revenue model. In many cities, vacancy rates are higher than you'd expect, yet rents are still going up. That's less about pure supply and demand and more about pricing power and market control. Reason 3, the hidden tax of money creation. Whenever the government expands the money supply, something that happened aggressively during COVID, the value of the dollars you already hold quietly drops. That loss of value is like an invisible tax on your savings and your labor. You didn't overspend, you didn't mismanage anything. The system simply made your existing money worth less. People in charge of these policies often hold assets, stocks, real estate, businesses that tend to rise with inflation. Their wealth moves up with the tide of new money. Your wage and your bank balance, they usually lag behind while the prices of the things you need race ahead. There's another layer to this that's more psychological than numerical, a kind of mental manipulation. It's called anchoring. Over time, you're trained to accept higher prices as the new normal. Think back to the first time you paid $5 for a coffee. It felt outrageous. Now, $7 barely registers. Your internal sense of what's reasonable has been reset. Then you hear inflation is cooling, and your mind interprets that as prices will come down. But cooling inflation doesn't mean prices are falling. It means they're still rising, just at a slower speed. You're still losing purchasing power. You're just losing it slightly more slowly. It's like being told a sinking ship is taking on water 10% slower than before. You're still going under. There's also shrinkflation. Same price, smaller product. Your cereal boxes get thinner. Your chip bags are mostly air. Your chocolate bar has a new shape that conveniently hides that it's 15% smaller. You pay the same, but receive less. Many people don't notice the change, but they absolutely feel the impact on their budget. Marketing phrases like right-sizing for the modern consumer try to put a positive spin on it. In reality, it's a quiet way of charging you more without changing the number on the price tag. And if you've ever caught yourself wondering, am I imagining this? Was it always this expensive? You're not imagining it. You're being subtly gaslit by an economic setup that works better the less clearly you see what's happening. So what can you actually do in the middle of all this? First, understand, this situation is not a reflection of you being bad with money. The rules of the game are structured in a way that makes most people lose ground over time. Recognizing that is the first step towards not playing entirely on their terms. Here are a few areas you do have some control over. Stop leaving too much cash in low-interest savings. With inflation around 2.8% and many bank accounts paying something like 0.5%, your money is slowly eroding. Consider instruments like I-bonds, treasury securities, or genuinely high-yield savings accounts that at least aim to keep pace with inflation. Buy in bulk, strategically. Focus on non-perishable items and household goods you know you'll use. When you can lock in today's prices for products you'll need in the future, you're effectively protecting yourself against future price hikes. Build financial literacy. Learn the difference between assets and liabilities. A car, in most cases, loses value the moment you buy it. That's a liability in wealth terms. Investments that can grow in value or generate income, like diversified portfolios, are assets. Push for fair pay. If your income hasn't increased by at least the cumulative rate of inflation since 2020, roughly that 28% figure, we're not talking about a flat outcome. We're talking about a real pay cut. Know what your work is worth in today's terms and negotiate when you can. Most importantly, stop blaming yourself for struggling to keep up. The environment you're operating in is tilted against you. The fact that you're watching or listening to this means you're already ahead of a lot of people who never question any of it. Use that awareness to make better decisions where you can. So again, what can you do about it, practically? Remember, this is systemic. You didn't design the rules and you can't fix everything alone, but you can adjust how you respond. Don't let too much of your wealth sit idle in accounts that lose value after inflation. Treat bulk buying of essentials as a small hedge against future price increases. Keep learning about budgeting, investing, and how the financial system actually works. And when it comes to your job, evaluate whether your pay has genuinely kept up, not just in your local currency amount, but in what that money still buys. Above all, drop the guilt. The pressure you're feeling is largely a result of systems and policies far outside your control. Being informed is already a powerful step. If this shifted how you see what's happening around you, share it with someone who thinks they're simply bad with money. Chances are they're not. They're dealing with the same tilted playing field without the information to understand it. If you want more straightforward explanations of economic issues without the sugarcoating or the sales pitch, stick around for future content. I focus on what the numbers actually mean for your life.
Let me know in the comments, what's one everyday item that has gotten so expensive it honestly shocked you? I read every reply. And remember, knowledge is the one form of wealth they can't devalue. See you in the next one.